So here's AMD. I'm going to examine the original trade that we took and then sort of the history or anatomy of the trade. And then I think I'm going to take some of it off. We'll see. But let's talk about AMD. So AMD on the 13th of June, right? So if you didn't see this, if you look at AMD on the 13th, that was right here. It looked like we were getting a reversal, right? You had the sort of the little bit of a topping pattern here in the RSI, and the RSI starting to head lower. You saw this hit the upper Bollinger Band and the 200 period simple. That's the 200 right here. This is the upper Bollinger set at 2.5. Hit the upper Bollinger and reversed. Reversal candle, confirmation candle, and then it got below the daily 20. This was semiconductors were starting to sell off a little bit. When we looked at SMH, we saw a double topping pattern there, and it started to fall. I didn't want to select NVIDIA because NVIDIA was just, you don't want to, first of all, premiums were high, and you just don't want to mess with NVIDIA. If you think the semiconductors are falling, the last one you pick is NVIDIA because they're usually the first ones to get a little goose or a buy the dip. So if semiconductors drop, if it's NVIDIA that drops a little bit, they're the first ones that get the buy the dip action. So I didn't want to short that. We looked at a bunch of others, semiconductors at the time, if you guys remember, and we took AMD. Now, right here, if we look at where price was sitting at about 118, 117 when we took trade. So my alert on the 13th said I'm going to pick AMD for July. So I'm going to give myself over a month for this to do whatever it does and trade it down to the lower Bollinger. That's kind of sort of where my target was, like somewhere around here but not at the lower Bollinger, before it. So the lower Bollinger was at the time here was at about 108. And so that's a nice fat round number, 110. So the trade that I took was the 115, 110 put debit spread. So look where we are. We're here, and I'm just looking to see if this could get to here. Remember what I said, in steps, right? Just that. I'm not looking to drop it down to 100, or just to here, from here to here. But as you can see, this started to move against us, right? Started to go higher. And then, at this point, you've got to think about potentially abandoning the trade, because now you just took out this high. Something you might want to consider, just get out of the trade, right? So on the 25th, as we continue to pop higher, I wrote NVIDIA was getting a lot of love, it was getting squeezed, and if it were not for NVIDIA, the market would be negative. MU had earnings, it was good, but their guidance wasn't, and it went down. You never know what's going to happen, but I'm going to roll my AMD vertical. Okay, so I still believe, based on the other semiconductors, the overall economic outlook, even though we were here when we took the trade, I'm gonna believe that this is so extended and so overbought here on the RSI that I think it's going to go down. But here is the problem. The problem is that my trade is here. So even if I'm right and it goes down, I'm still out of the money. In fact, I'm out of the money by like 20 points because of this recent surge. But it's so overbought and it's overstretched and overvalued, and the semiconductors are leaking oil. I got to stay in this trade, but I've got to redo the trade because even if it goes down, it's too far away from my strikes. Now, the good news about the trade is that it's for July 18th. So I've got time. But even if it does what it needs to do, I just think I'm too far away. So what I want to do is I want to roll this trade. So watch this. This is 115, 110 put debit spread for July 18th. That's what we have. So what I did and it's in my alert. It says I'm going to roll my AMD vertical up, meaning instead of rolling it to the future because I'm running out of time, I have time. What I need is to roll it back to create a credit and lower my cost. That's one way of looking at rolling it, up or rolling it closer. But because my strikes are so far away, I'm going to change the strikes as well. So had I just taken this, so the initial trade was $1.80. If I had just taken this trade and rolled it back to like 7-Eleven, I would have gotten like about a $20 credit, because they'll give you a credit if you want to slice off some time. They'll give you a credit to do it. So I could have rolled it back and lowered my cost, to $1.60. You could have rolled it to this Friday, and you probably would have gotten 40 cents, maybe even 50 cents, and I could have lowered my cost to 130. But that doesn't accomplish what I needed to because I'm still too far away in strikes. So I rolled this thing backwards, and I'm going to write it over here, to this Friday. And instead of getting this nice big credit for it, I used part of the credit to change the strikes. And if you look at where I was at the time that I took the trade, I was at about 136 or so. I think I was right about here. So I changed the strikes to 139, 136. I went a little out of the money, a little in the money, a little out of the money. So this seemed like it makes sense. Now, I know I had a 5-wide vertical, and it was all the way down here. I changed the strike. I kept changing them until I could find something that I liked. And then I liked this. And this only cost me 65 cents. So I rolled it to July 3rd, and I changed the strikes to 139, 136, so that between then, which was the 25th of June, and July 3rd, I have enough time to do what? All it has to do is stay below 139 to be in the money, and I could get some of my money back. So here's what I wrote. Roll the 115, 110 put vert up to July 3rd. Change the strikes to 139, 136. Cost is 65 cents. Initial trade was 180, so I'm in for 245 now. It's only a 3-wide vert. But all I'm looking to do is to see if I can get $2 out of it. Because if I could get $2 out of this trade, it means I only lost 45 cents. Instead of losing the original 180, I'd only lose 45 cents. And if it continues to move the way I want it, I can buy more of these because the cost was only like, 30-something cents, 35 cents. So if I average down, it brings my cost down even lower. Everybody with me so far? So I did, in fact, roll the trade. The AMD trade now sits at 7.3. It'll expire, in 2 days. I got the 139, 136 put vert, and I'm in it, as we know, for 245. I think mine's a little less, but I think I'll just put 240 because I think that's what I've got. All right. Any questions on that? No questions on that. No? And you can change the past. All right, so there's more. So then the next day, the next morning, guess what AMD did? Well, AMD went higher. Bastard. So what did I do? I averaged down. So I got more of them. Now what I did was I did half of them. So it's usually how I operate. So I had a good number of them, even though it was a pilot position, but they were fairly cheap. So I rolled half. And so the next day, when for the ones that I rolled half of, I bought that same amount at 65 cents. So I added to the trade to average down. So on half my trades, that now cost me about $1.47, right? Because what is this? 240 plus 65 is 305 divided by, well, it wasn't 240. What did I do here? Oh, it's close. This says 152, but it ended up being 147 for some reason. Around 150 because I averaged down. But I didn't do it with all of them. I did it with half of them. So yesterday, the roll, if you were to roll it, you could then roll it for only 33 cents. So I took my other half, because remember, I have until July 18th, so there's not a big rush here. I rolled my other half for 33 cents. And then I rolled the 115, 110 put from 718 to 73, changed the strikes. All right, and see, then I alerted I was averaging down, bought more of those at 65 cents. They're now only 40 cents. So let me just show you the math, and then I'll show you the next portion of the trade. I'll draw it out so it makes a little more sense. All right, so we started out with 115, 110 put debit spread for July 18th. They cost $1.80. I think my cost was a little less. I'm just going to round off. Then I rolled back to 7.3, half of them, to 139, 136. And it cost me 65 cents for half of them. So half of them cost me 245, and the other half still cost me 180. Right? The other half, and then from here I averaged down. So I bought 65 cents. I averaged these down. So now my cost is $1.55. It was really 140. I'll just round it to 150. It was 147 is what my platform showed. So half of my trade cost this. The other half cost this. But then yesterday, I decided to roll this one back. And this roll was only 33 cents. Or was it? Yeah, it was 33 cents. So this one, if I look at that, cost me $2.13. But so then, once I had these for $2.13, then I averaged those down. And those only cost 40 cents. So now, you can divide that by 2, and you get $1.26. All right? So I got half of them at this and half of them at this. So if I add those together and get an average, about 138. So now the whole trade cost me 138. Except for the fact that the second part of this, or the third part of this trade. So yesterday, what I said is now I'm selling a credit spread. So if you look at where price was as it starts to come down, and you have it's about at 140 or so is where price was yesterday. I went all the way up here to 148. I sold the 148 call. I bought the 152 half call, and I got a 48-cent credit for it. This is a call credit spread, and it's for July 3rd. And if price closes below 148, I get to keep the credit. Yeah, you just click on roll. Really, if you have TradeStation, the same place that you go to close the trade, if you collapse the vertical and you click on the 3 dots to close the trade, you'll see right below close the trade is roll. You could also just close the trade and then buy the new one, which is essentially roll. Yeah, I know it sounds confusing, but it's really not if you follow through here. So anyway, this call credit spread here, I got 48 cents. So 48 cents for it as long as price stays below 148. Look at the cost of my trade now. 90 cents. It's actually 92 is what mine came to. 92 cents. So I now have the 139, 136 put debit spread for this Friday at a cost of 90 cents. And oh, by the way, if I go right now to close that trade, it's worth $1.70. I could close it right now for $1.70. Now, one of the things that I'm going to do, what you could do, is you could close this call credit spread. What happens if the market skyrockets, it jacks up tomorrow, and AMD goes up to 150? Well, you've got risk. So you could just buy back this spread for 3 cents. But you don't even have to do that. You could, if you wanted to save the commission, for 6 cents, you could just buy back the short strike. So all you'd have to do right now for 6 cents is buy back the short, which I'm going to do right now. So what you do is you go to close the position and you just X out the other strike. So all you're doing is closing one of them.
Order filled.
There. Now I no longer have that vertical. So what I have actually is I have the 152 half calls for this for next 2 days. They cost me nothing. They're just sitting there. They don't really cost anything because the trade is over. I no longer have a call credit spread. I have zero risk. And now I can just go ahead and, if I wanted to, I could close right now for 162, it says. Right now I could close this trade, it dropped a little bit, to 162. Right now. And I'm over and I'm done. Now remember where we started. So this, I'll just kind of recap so it's not confusing. We started out with a $1.80 put debit spread, but we did a roll. We rolled it forward. So when you go to roll, it automatically populates the next date available. So when you go to roll, it puts it to 725. It basically is going to say, okay, we will exit this trade, take whatever money you got left, and we'll put it into the exact same trade here. That's what a roll is. But then you can manually go to the date, change the date up. That would create a credit if you were to take the same trade. But I didn't take the same trade. So I changed the strikes in that trade to this. And that, instead of it being a credit, cost me 65 cents. And that's why the trade ended up being at 245. I did that for half of them because I had 8. Yeah, I had 8. So I did that for half of them, 4 of them. So once I did that and my cost was now 245, I then added to the trade. So I bought that same vertical now costs 65 cents. Well, my cost right now is 245. I still believe in the trade. So I bought an equal number at 65. I averaged the sucker down to 150. Well, yesterday, even better price. Now I could do this same roll on the other half. Here's that 180 initial cost. Instead, that roll only cost me 33 cents to roll it, which means my cost now is 213, not 245. And I could buy more of them and add, just like I did before, at 240. Average it down to 126. So now I've got 16 of these with an average cost of 138. I want to bring it down even more. because I want to get out of this trade. So I go all the way up to 148, where price was yesterday was 140. I go all the way up to 148, and I do this little, 4.5 wide call credit spread for 48 cents. I basically wanted to get the trade under a buck. What call credit spread could I do that would give me about 40, 50 cents so I could get this trade under a buck? This is what I found. I got that. That brings my cost down to 90 cents. It's actually 92. And I just bought back the short strike for 6 cents. So now I'm in the trade right where I wanted, 98 cents. I have no risk other than 98 cents. And I could sell it right now for $1.60. Got it? What was the price of AMD when you got their first roll backwards? I don't remember. The first roll. I could show you that. It was 3 o'clock in the afternoon at 6:25. It was probably somewhere around 140. Somewhere around 140, 141, Zlatko. Yeah, somewhere around here when I got the first roll. So that's what's happening. Now, AMD is, it's coming up a little bit. I'm going to watch it. I'm going to see what happens towards the end of today. We might get more out of it. Now, remember, it's a 3-wide vert. So it could be worth up to $3. So for me to get out of it at 160, I'm leaving some money on the table. But what a recovery, right? Look at this. Got it here. It's way extended. I still believe it's going to roll over, but I have plenty of time for it. But it's moved up so much that my strikes here just aren't valid anymore. So I roll backwards to get a credit, but I don't want to keep the strikes. So I change the strikes so I can be in the money, out of the money. So even if it goes sideways, I could have a shot. I literally put the strikes right at the money here, 136 or 130, 139, 136. I put the strikes right here. So even if it went sideways for a while and then took a little dip, I'm good, right? I don't need it to come down to here or here or here. I just need a little bit of a movement. And I was willing to pay 65 cents for that on top of the $1.80. So that's $2.45. But because I've got plenty of time, I just did it for half of them. I did it again yesterday, and instead of spending 65 for the roll, it only cost me 30 something for the roll. And instead of doubling down at 65 cents and averaging down, it only cost me 40 to average down. So now I got all these things. I end up with 16 of them, but my average cost was only about $1.50. So then I do 16 call credit spreads, bringing in 48 cents on each one, and now my cost is around 90 cents. Risk on the call credit spread, buy back the short strike right now for 6 cents, and now you see what my cost is. Actually, 98 cents. And I could sell it right now for $1.60. Chink. Sounds complicated, but conceptually, I think you guys understand a few concepts. Number one, if you still believe in the trade, you can roll it. If you're in the money, stay in it. If you're close to being in the money, which is what will bring me to some of the other trades that we have on. So we've got XLF, we have XRT, we got we got rid of Exxon Mobil and XLE. We got out of those trades with a profit. So we've got, a couple of trades on that are out of the money, but they're for July 18th. The question is, how far out of the money are they? If there's still a good chance that they can get in the money and you still believe the market could pull back, you stay in the trade. Even though you might be down by 70%, and that's your trading plan, part of your trading plan eventually will become technical analysis as well. Yes, I'm down by 80%. I should have gotten out of the trade, me personally. But some of these trades that are out of the money, I have until the 18th of July, and they're close enough where they could get in the money, especially if I believe the market might pull back, which I do. And I'm always interested I'm always interested in looking at ways that I can reduce the cost of my trade. So, as an example, if I'm in a trade here and I want it to go like this, and it costs me a certain amount of money, and it goes up and then starts to fail, there's a couple of things I could do. I could average down if I wanted to, right? Because now if the trade cost me $1.50 and now it only costs me $1 because price went up, but it's coming back down. So I believe in the trade. I have hope. The trade cost me less here, so I could average it down. That is one way. Another way to reduce costs, and let's say the trade's all the way out here in the 18th of July, and I've got time, I could go with a short-dated credit situation. Because remember, if price is moving up like this against me, that means premiums are high. And if premiums are high, I could sell some premium up in here, have it expire, and that reduces my cost, which is what I did with AMD. Premium was high. So I went all the way up. When price was at 140, I went all the way up to 148, which I didn't think AMD was going to move up 8 more points. Start making a stab at 150? I don't think so. There certainly were not a lot of 150 calls for this Friday versus lower puts. So I went all the way up here and shorted the 148 call. And I bought the 152 half that gave me $47, and all I got to do is stay up. Now look what happened. It's not even it's 2 days from expiration, and I was able to get out of this trade for 6 cents, which means I netted a $41 credit in 1 day. Do you guys get that? So the value of this trade was 48 cents when I got it. The value of the trade right now is only 8 cents or whatever it is, 5 cents, 4 cents, because price is so far away from it, which means you can buy it back. You could buy back the whole darn thing if you wanted to for like 8 cents or something, or 6 cents. I think you could buy the whole thing back, or 8 cents, just buy back the short strike and save yourself the commission of the other one.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.